Welcome to the Cashflow Academy Podcast. I'm your host, Andy Tanner, and this is where we do our very best to make investing simple. Could not be more thrilled about today's show. We're going to talk about really two of the foundation, fundamental, staple skills for investors today, and this affects everyone, whether you're a small-time investor or whether you're wanting to learn more about how the big guys do it. We're going to speak about some very important foundational principles of investing, and I couldn't be more excited. Drop by, make sure you like and subscribe and hit your notification bell so you don't miss any of our episodes. And also remember, drop by yourinvestingclass.com, yourinvestingclass.com for free stuff and great education. My guest today is Jeffrey Hooke. He teaches at the business school at Johns Hopkins. Could not be more thrilled to talk about his books. We're going to talk about two or three. His most recent book, you can drop by Amazon.com, The Myth of Private Equity, an inside look at Wall Street's transformative investments. So we're going to talk about broad valuations of fundamental analysis, but also funding projects and how that has evolved, the pitfalls that can be there, and the advantages as well. With that introduction, just a huge thank you to my guest, Jeffrey Hooke. Thank you for being on the program today.
No, it's a real pleasure to be here.
Awesome. Let's start off with the background a little bit. Tell us a little bit about how you started, how you decided to study your particular field, and how you wound up. You do a lot of stuff here, a lot of consulting. Obviously, you teach. Tell us a little bit about your background.
All right. So my teaching career, Andy, started relatively recently. I joined Hopkins 5 or 6 years ago after a long stretch in Wall Street type jobs. So when I got out of Wharton like 35 years ago, I started working on Wall Street doing various private investments for a big company. And then I shifted to the advisory side, and I worked for a couple of investment banks up in New York doing IPOs and merger deals and private placements of securities. And then I moved down to Washington, and I worked in international finance, including private equity, for a couple of big institutions, one World Bank being one of them. Another one was a $5 billion private equity fund. And then I moved back after getting tired of traveling internationally all the time. I moved back into investment banking for a local Washington-based investment bank, and did that for about a dozen years. And as you mentioned, along the way, I wrote a few books because I have a bit of an intellectual bent that you tend not to find with Wall Street types. So I always wanted to challenge myself to write a book. And so the first book I wrote was on mergers and acquisitions, sort of how you do one and how you value companies, as you pointed out. And then the publisher wanted me to look at writing, sort of as you indicated, a rewrite of the old famous Graham and Dodd book, which hadn't been updated in 30 or 40 years. So I did sort of a modified or modern version of that, which would include a lot more valuation techniques that were more up to date than Graham and Dodd, which was so balance sheet focused and so conservative, because it was originally written in the 30s. And people thought after the great crash in 1929 that buying stocks was highly speculative and very risky and a good way of losing your shirt. Maybe that was true. For 25 years, the stock market didn't move. And so, it was an updated version of the security analysis book. And it's used as a textbook, but a lot of practitioners and investors buy it. And then I wrote a couple other books on the emerging markets, which is investing in developing countries based on my international experience. And I wrote an exposé of the World Bank. The private equity book that you mentioned came out a couple of years ago. And it was initially a book based on my skepticism, having worked in the business, about how great private equity supposedly was or is. And, the exposé basically trots out, what a private equity is, what are the real returns, why has the myth been perpetuated by the media and by the private equity firms themselves, and even the investors being complicit in pushing the myth. And that's the genesis of it. So a lot of people are fascinated by private equity as well as valuation. And so I hope, we can cover these topics in the next time allotted.
Well, I'm excited to dive in. I get nervous there's an old saying that says it's better to be silent and thought a fool than open your mouth and remove all doubt. And
Right.
so it was in that spirit. I thought, why don't I do a podcast? and so when I started the podcast, I thought, well, this will absolutely reveal myself as a simpleton, but I'm going to do my best. So,
But you provide such a good public service, because I talk to friends and family who really don't know. They may know much about medicine, or they might know a lot about computers or something, but finance is always sort of an opaque, mystical type of field, and people are a little reluctant to engage with their money managers for feel of being, considered dummies or what have you. But you got to ask the right questions and investigate just to protect your own funds.
100%. So let me begin here. This might be a bit verbose, so if you'll be patient, I'd like to share with you my thoughts on those two ideas in securities analysis in terms of valuations, and then the idea of private equity. The Graham and Dodd book was interesting because it's really a book on bonds. There's only one chapter on stocks. And from a risk standpoint, there's an order to it. If things go bad, bondholders are in line before stockholders. But the underlying strength of the business that's either going to pay a dividend or is going to pay interest on a corporate loan, you have to have a strong business. So the foundation of fundamental analysis of saying, price is going to be what I pay. It's meaningless in and of itself. In isolation, price means nothing. I need to know what I'm going to receive. And so we have all of these ratios: price to free cash flow, price to book, price to earnings and growth. All these valuations come in. So whether you're in real estate or business, the ability to understand where the value is a huge skill. So that's one thing. It's fundamental analysis, I believe, is one of the four pillars of investing. You have to know how things are valued. Now, on the other side of this is where the verboseness gets worse. If you want to buy something, you have leverage. And what leverage does is, in my mind, it's a bit of an accelerator. I can do more with less. I can buy more house with less money if I begin to finance my home, right? I have a down payment. And as you look at a scale, if we were to think of the basic rule of risk and reward, that the more reward I seek, the more risk I wind up taking, we go along, maybe we picture a 45-degree angle of a graph with, a y-axis of risk and an x-axis of reward. And we have this 45-degree, the more reward, the higher the risk, the more reward, the higher the risk. But that changes in what I think is, I often talk about, you start going fast and fast. Pretty soon, you're in the Starship Enterprise and you start doing what we call warp speed, to where if you take the compounding formula, which is really, the current value of investment subtracted by your initial investment, divided by your initial investment, you're going to get rate of return. Well, if I can do a real estate syndication and I know my NOI, I know all my numbers, and the bank says, we'll fund this much. Here's your debt. But you have to put in this much equity. If I can say, I'm going to use private people to do that, now I have a zero investment on my own part. And now when I plug that in to that compounding formula, I'm dividing by zero. My rate of return becomes infinite, and my risk personally becomes zero. I've effectively done more with less and more with less and more with less, and I've pushed it more with less until I'm now doing everything with nothing. And that's an interesting way to look at it. There was a syndication pitch on a webinar, and my son was watching with me because I wanted him to learn, and I said, what's the biggest thing you learned from this? He said, sponsorship equity. Because the guy that is putting this deal together has the debt from the bank, the equity from private investors, and he's doing everything with nothing. His personal risk is limited to his reputation. Now, with that long-winded background, I think it's fascinating to talk about, if people understand those two things, how to value something and how to buy it without any of their own money, that type of leverage. The amount of greed, the amount of temptation to pitch something in a way it shouldn't be pitched, to promise returns to those private equity people that are less realistic, that temptation would almost become irresistible. So it's kind of with that context that I come to this conversation thrilled about both books. The idea of learning,
let's examine your 2 points. First, no one's going to argue that before you buy something, whether it's a stock or a commercial building or even a house to rent out, that you should know what the proper value is. And the tools you mentioned, like the PE ratio, or in Wall Street they like to use enterprise value to earnings
over
interest
EBITDA
and tax ratio, or enterprise value to sales. Real estate, it might be the property's rental income divided by its the price you're paying. I mean, the purpose of a lot of these ratios is to see if you're paying a fair price. So let's just pick a stock, for example. Let's say the stock you're thinking of buying is trading at 20 times earnings, okay? So the first thing most people would do in the business would be to see where do similar stocks trade. And so if the similar stocks, and you can do this on Yahoo Finance or some other sites, they'll tell you what the similar stocks are, and you can just pick out their ratios of value. And there's several ratios that are on that website. So you pick 5 or 6 stocks, and if the average PE ratio is 18 and the stock you're looking at is 20, your first conclusion is the stock is overvalued compared to its peer group. And so you might hesitate and say, well, I don't want to buy something that's inflated in price, but there may be some good reasons why it's trading slightly higher than its peer group. It may be growing faster. It might have a better prospects for new products and new markets. So these ratios are sort of a guide. And if you're in the real estate angle and you're thinking of buying a commercial property, it's the same thing. What is the first thing you look at before buying a commercial property or a house? You have somebody run the comparables for you. So you look at comparable commercial properties, where they trade in terms of price per square foot or price per rental income, and same with a house. Everybody before buying a house looks at all the comps. So the stock market and the real estate market are very similar, that people tend to look at comparable stocks or comparable properties, with the backup approach being, well, what's the income going ahead to, what's it look like? And you might provide some modifications in your value for that. Just let's look at the real estate angle, because it's a little simpler. You might look at a house trading for $600,000 and all the comps are trading at $800,000. Well, there's probably a reason why it's at $600,000. Maybe it needs a couple new kitchens, a couple bathrooms, needs the garage repaired. And if you do all that and then try to flip it, you might get a price for $800,000. If it cost you $200,000 to make all the improvements, you sort of broke even. So that's your first point. Yeah, valuation is really important. And if you're not prepared as an individual, because institutions with employees are going to do the same kind of work, so they're going to try to find the appropriate value for a stock or a piece of real estate. But if you're not prepared to do that as an individual, it's kind of time consuming. You're better off in an index fund. Now, the other point you raised, which I guess I'd agree.
Can I ask? Can I do a follow up on the first point? Because
sure.
I'm here to learn something, and I love your perspective on this. Let's say I am in an index fund, and let's say I'm a 401k guy. Mm-hmm. And you mentioned, people sitting at the dinner table, they're going to talk about Lindsay Lohan's parole status rather than their,
Right.
And so think about this. Let's talk about this idea of comparison that you raised. It's kind of like going to the grocery store. Apple, here, I'm going to thump the watermelons and see which watermelon seems like it's the best value for me compared to the other watermelons I could buy. Tell me about comparison to history. For example, if we look at the Shiller PE today, and I haven't looked at it recently, but I'm going to guess it's probably creeping 38, something like that, I imagine. So if I look at an index fund that trades the S&P, and I say, all right, I'm going to pay $38 a price for an S&P that gives me $1 a year earnings. But then I compare it to history, and I say, well, the mean is over the last what does the Shiller take in? Probably since 1880 or something, last 140 years. It's been at 16. So I think of my 401k guy and I say, okay, first of all, as the S&P climbs, I have a set amount of 401k money I'm putting in there. I'm getting less shares because they're more expensive. I'm getting less shares if you want to look at it that way. I'm getting less asset, and I'm also getting less production from that asset. How do you feel about a guy like Warren Buffett who hates cash, but he's got $200 billion on the side because he doesn't see value in the market right now? How do you think about the comparison to history, or do you say, hey, it's a new day, that's what stocks cost now?
Well, I think the latter is accurate. It's a new day. People don't put a premium on risk in stocks like they used to. Interest rates have been historically low for many years, and that pumps up the valuations. But for the average person, I mean, they're not putting all their 401k in today at what I think are inflated valuations. You know, they're doing it over time, so hopefully they've been putting money in for the last 5 or 10 years. If I were to recommend to someone, let that fellow, hit the lottery or something, I would say certainly don't put 100% of your money in the stocks today because, as historically they're overpriced. So you probably want to go in, if you hit, a big inheritance or a lottery, maybe you go in at 50-50 or something because, I think there will be some pullback. I'm not sure what's going to cause it. I've been saying this for 2 or 3 years and I've been totally wrong, but so have a lot of other people. So, you got to be careful that you don't blindly put a lot of money into an index at these prices. So history is a good lesson to follow.
And then before we move on to funding, last thing, speak about what you believe about potential detachments, because when you get onto Wall Street, you have high frequency trading, which is a capital gain focused exercise. I'm trying to buy low and sell high all the time. Yep. If I go on CNBC right now, they're going to be talking about prices, price, what's up, NVIDIA down, up, down. Where most people approach the market from a capital gain perspective, buy low, sell high, there can be a pretty significant detachment from the value, what you might value something at, and the excitement, the irrational exuberance of the market. Can you speak to that detachment, what you see there?
Let's talk about trading in and out first. So first, the commissions are pretty high for individuals to trade in and out, even though there might be 0.5% or something that adds up. Secondly, if you're trading in and out and taking these quick gains, or you could be taking quick losses, this is all taxable. It's not capital gains. You've got to hold on to something for 6 months or a year. And that's what a lot of people forget is as an individual, you're not a big institution like a nonprofit and university endowment or state pension plan. If you're trading in and out, those gains are going to be taxed at your normal income rate, like a 1099. So that's a real negative to that. So I think people, at least that do trade a lot, they're somewhat detached from that fact. I don't know if they're necessarily detached from the valuations or realizing that the market's pretty high. There's certainly a lot of momentum trading going on with meme stocks and that sort of thing. And I just don't think people that are doing that are consistently beating the stock market. In fact, if you look at most hedge funds, if you look at most actively managed stock funds, these people that live and breathe the stock market 24/7, 90% of them are not beating a simple S&P 500 index.
Absolutely true.
So that's why I think people, unless you're a full-timer, studying this, you're just going to have a very hard time beating the stock market. And so that's why I think some indexing is probably more appropriate because the fees are so low. Even if you go into an actively managed fund, something sold by T. Rowe Price, for example, or Capital Group, those guys are not going to beat the market, and they're going to charge you 1% a year. So this is something I run into when I have people older that, I'm not that young, but older people who are retiring, and they're saying, well, where should I put my money? And when I look at their accounts with these big institutional money managers like JP Morgan or Capital Group, if you look at the portfolios, they're really not beating their corresponding index. and yet they're getting charged 5 or 10,000 a year. I just think it's a bad rap for them.
To your point, if the SPIVA, the S&P index versus actively managed funds report comes out every year. And to your point, I think the last one they said, I think it was 89% of funds have failed to beat the S&P over the last 15 years. And to your point about a 1% expense ratio, Warren Buffett uses the term enormous because I don't think it's the 10,000 a year that they're spending. I think it's the loss in compounding power over their life, because
Yeah.
if you take any compounding calculator and put your lifetime in there and just take 1% off of that, the compounding effect that slows. It's not the fee in and of that single year. It's the compounding headwind that it creates. Let's talk. So bottom line is, learn, if you're going to be a serious investor, pick up a copy of Securities Analysis and learn a little bit about how this works, specifically Securities Analysis on Wall Street, comprehensive guide to today's valuation methods. And this is really important because in the 30s and 40s, we did not have, well, first of all, we didn't have an options market till 1968. We didn't have the derivatives market. They weren't talking about collateralized debt obligations in those days like we were in 2007 and 8. So the derivative market today is so huge, really important to understand a modern view of securities analysis. Talk now, tell us a little bit about private equity. The book, The Myth of
One
Private
point, I don't want to discourage people from taking up stock market investing as a hobby. I think, if I talk to people, I say, if you're going to buy stocks, you should 70% or 80% ought to be indexed, and you leave 20% as play money, where you buy meme stocks, you pick flyers on things, you pick stocks on your own based on your analysis. I'm just saying, well, you can't beat the pros. You can't beat the people that do it full time, even though you run into a lot of people that say they do. You just can't believe them that much. It's just impossible to beat somebody that's, these top schools grind out these people and they go working for these money management firms. So it's tough for us individuals to beat them. I've tried myself, but I have other jobs to do, as you pointed out when I started. So if I put a lot of time in, I can probably beat the market by 2 or 3 points a year, but that's just a lot of work to do that.
Well, if a person beats the market at 2 or 3 points per year and they compound that, like you say, let's say someone did just that. Let's say someone says, I'm going to do this myself, and I'm going to get that 1% that I used to pay Wall Street to do it, and I get another 2, 3 that I'm doing myself. For example, what I found a lot of success with is, rather than worrying about capital gains, I'll tell you where people can't beat the market is if they take a capital gain approach. I don't know where Apple's going tomorrow. I have no idea. Neither do you. Neither does Warren Buffett. Neither does anybody. But what I can do is I can look at a stock like ExxonMobil, and I can see it dropping COVID down into the high 30s. And I can say, you know what? That's a good business. COVID has made oil cheap. That's a dividend of $1. I mean, it's 98 cents right now every quarter. That's $4 a year. So I can buy that stock and have a dividend from a company that raises that dividend every year for 35 years straight. That's not guessing on price. That's seeing a 35-year history. And then I say I'll put that in a Roth where it's tax-free. And then I'll say I'll write some very conservative covered calls on that, pick me up another 2-3% a year. But the big guys can't do that. Buffett used to do a lot of option writing, but he's gotten too big. He said so in his letter. He says, I can't double. So I do think that if you take a cash flow perspective and you find solid companies that have solid history of dividends that aren't going away, and you do some very conservative covered call writing from a cash flow standpoint, sure, since I bought Exxon, it's gone to 100, as high as 120. I don't care. What am I going to do? Sell it? It's a cash flow based. That's why I call my company the Cash Flow
I saw
Academy.
that whole approach on your site. I happen to agree with you. I think buying a lot of dividends paying stocks is a good strategy, because you're going to be tossing out the really high flyers, risk ones that tend to collapse and go bankrupt, whereas a
Yeah.
steady dividend payer usually means a conservative, strong business with a good market share. And there are index funds that copy your exact approach, and I think it's a good one. So I would, particularly for younger people, getting steady income, and then you can to reinvest in the 401k. And I mean, you may not be hitting 40 or 50% a year, but as you said, with a compounding approach, 10 or 12% is going to work just fine.
Yeah, and if the market's at 8 to 10, you get 10 to 12. I took my sons out of school when they hit the 8th grade, not simultaneously in sequence, and I just spent a year at home of financial education. And now my older son's a senior, and he knows it's not that tough. In 1 year of education, he's maintained his portfolio by himself for 3 years.
Yeah.
That's a great life skill to have a kid that knows how to write a call.
I totally agree. It would be nice if more people in this country had that kind of background. And I think a few school systems are trying to put in a 6-month course on financial education, anything from opening a bank account to taking out a mortgage for a house or buying into a 401k. It's a very good practical experience.
The wealth disparity is not we shouldn't try to make it equal of cash flow. We should we should focus on the balance sheet rather than the profit loss for people, because if we go to COVID and we helicopter money to help people pay rent, pay groceries, with helicopter money, that money goes to me. They're going to spend it, and it goes to the producers. So my thought would be is if they would teach young people ownership and learning that they will share. Steve Jobs will share his technology with you. NVIDIA, they will share their genius with you. This entire GDP is shareable if you'll simply go out and get your share as part of your financial education. But anyway, that's neither here nor there. Tell me a little bit about the myth of private equity. What is the myth of private equity?
Just to start off, the book's an expose of a business that I'm intimately familiar with, having worked in it and worked as an investment banker for a lot of years. So the myth of private equity was an outgrowth of my experience and skepticism about the business. So the business, of course, as touted by people in it, by Wall Street in general, and by most of the business media, is that all these guys running private equity funds are geniuses. They're hitting the cover off the ball in terms of rate of returns, far outreach in the stock market. If you drill down and look at the facts, which a lot of people do not like to do, they like hype and they like marketing because it's very profitable, you'll see that most of those things are not true. So, I don't even know where to start, but let's start with what private equity is, and then I'll stand on my soapbox for a little bit. So private equity, for those of your listeners who are, have some passing knowledge, is basically leverage buyouts is the biggest part of private equity, followed by venture capital and growth capital. So leverage buyouts, which everybody's heard of, is when the private equity fund, which is mainly backed by big institutions like state pension plans or university endowments like Yale or Harvard, they put up most of the money. They will buy companies and use a lot of debt to finance the acquisition. So the private equity funds do not guarantee the debt. They're doing what you said earlier. They're trying to promote as much as possible and put in as little money as possible and therefore enhance the returns. So leverage buyouts, lots of debt, usually conservative type companies, paint manufacturers, supermarkets, maybe low-tech software and that sort of thing. That's a steady cash flow, almost what you described a minute ago, steady dividend or cash generating companies that can pay the debt off. And so experience shows that, say, in the 80s and 90s, these funds were beating the market. Now everybody's piled into them. There's thousands of them. It's just too competitive. And the fees are quite high. They're like 2 or 3% a year on your money. If you're paying 2 or 3% a year, it's just tough to beat the stock market. So that all that I've said in the book about leverage buyouts is sort of true, but the people that are promoting them clearly wouldn't like the book, and they have a huge marketing machines. They got hundreds of lobbyists in Washington to promote the opposite, and they've been very successful at it. So they keep grinding out these funds, even though the returns do not justify it, and about a quarter of all LBOs go bankrupt. So the return on that 25% of the deals is absolutely zero. So you do have some that multiply, and these are the ones that the Wall Street Journal, New York Times tend to talk about. The ones that do make 4 or 5 times their money get a lot of publicity. All the dogs that go into the toilet through bankruptcy, you hardly ever hear about them. Occasionally you hear some negatives about a company that goes under, and the latest negatives have been, a couple of hospital chains that have gone bankrupt because all the cash has been pulled out of the chain to pay the debts, and that leaves doctors and nurses, without the efficient hospital supplies. There's a shortage of people to clean up the rooms and so on. And maybe the legislature will do something, maybe they don't. They tried to get a law passed in Massachusetts to stop this sort of thing. The private equity lobby was too strong. They tried, and I live outside of Washington. The opponents of private equity have tried to get a few laws passed to prevent leveraged buyouts from promoting these abuses, and the laws are basically killed in the crib. So they're just too powerful for any book to just fight them. So that's really what the book is about, outlining what private equity is, simply buying securities in a privately owned company. A lot of these privately owned companies are identical to publicly owned companies. So, let's say a supermarket chain, you buy it privately. You can go out and buy the same kind of supermarket chain on the stock market.
We're speaking with Jeffrey Hooke, the author of The Myth of Private Equity, an insider's look at Wall Street's transformative investments. We're going to have a commercial break, interrupt us, and when we come back, I've got some important questions we're going to answer. So stay with us.
I am learning a lot, and it's easy to understand. Andy is fun. Andy's very enthusiastic to watch. He makes it a lot simpler to understand. I'm really benefiting from everything that he's teaching. I think the most valuable thing I've learned from Andy so far is the fact that it's not scary and it's easy to do.
Anybody can do this with the right amount of education, effort, and willingness to learn. You can learn it too. Andy, thanks for making this simple. Thanks for making this fun. Thanks for pouring your heart into this. Thank you very much.
Welcome back to the Cashflow Academy Podcast. I'm your host, Andy Tanner. This is where we make investing simple. My guest is Jeffrey Hooke from Johns Hopkins University Business School. His book is The Myth of Private Equity, an inside look at Wall Street's transformative investments. Before we went to break, you said two things that struck me that I'd like to highlight for our listeners. And I think they were two things that really hit a bullseye. Number one is you spoke about this perception that these guys were just geniuses and just smart. And when I first began my investing efforts as a student, I always felt there was this, to use your word, this opaque secret sauce that I would finally have this epiphany someday where I would be one of these people. And it was almost like I thought I'd be able to predict the future magically at some point, that I would be one of these guys. And what I actually found, and maybe I'm wrong, is that these guys aren't as smart as we think they are. So that's the first thing. If you look at even Congress and how they manage money, and the influence of special interest and emotion and power, and they don't make sound financial decisions all the time. The second, so that should give people hope. Don't think that this is unlearnable. I think is a great lesson when you say these guys, everyone thinks they're geniuses. They're not. Number two, that I thought was interesting is you say they're great marketers. And there's a joke I have amongst my friends. The bigger the brochure, the worse the deal. Because if you have to have a huge brochure, you're having to talk about something to pull my attention from how bad this deal is. If you understand valuations and fundamentals, you don't need a big brochure. You don't need a lot of flowery language. And so it's the education that allows me to cut through hype very, very quickly. So, we spoke about this idea of, the bigger the brochure, you got to be careful because there's going to be fluff in there the bigger it is. I just need no valuation. Speak to the importance of investing with the education of how to do valuations.
Well, I think if you're not ready to do some background work and analysis on the stocks you buy or the private equity or the real estate funds you're buying, you shouldn't be doing it. You're just going to lose your shirt because there's so much promotion and so much hype in this business that you're an easy target for, as you point out, poor disclosures, hidden facts, high fees. So you have to be prepared. You have to have some kind of ability and desire to investigate, lift up the rocks, and unfortunately read, all through the brochures, which Wall Street makes very difficult for you because a lot of the language is opaque, it's very legalistic, and it really challenges the patience of any investor, whether individuals, like a lot of people on this program, or even big institutions like the kind where I used to work.
I'd like to ask you a little bit about a Warren Buffett term. I think he might have coined the term. I don't know. Maybe it was the late Charlie Munger. But let's talk a moment about your opinions on margins of safety, or what a margin of safety might be. And I'll give you my opinion on it. You can teach me or move off of what I said. So in real estate, you got one extreme, like a guy like Dave Ramsey that says, if you gave me $1 billion 10 years interest free, I still wouldn't take it. That's just dogmatic. That's just silly. I mean, take that billion, buy some treasuries, and it's a no-brainer. So the dogmatic idea of zero debt is one end of the pendulum, and whenever you hit a far end of a continuum, you're probably in trouble. Either side, right and left, politically is a good thought. So when I look at debt, I'm going to say, all right. You mentioned it's really important to identify cash flow that can pay off debt. So if I run it too hot and my cash flow hits a rough spot, you get underwater, the tide goes out, and now you see you swimming naked, which is really an explanation of guys that are running too hot. The temptation, as we open the show, the more leverage I can get, the faster my rate of return is. But the downside of that is, especially with things like pension funds, a great example is the Studebaker company that got bankrupted in the 60s. They made so many promises in pensions that when you had a dip in car sales, you were dead. So the problem with I see with debt generally is the ability to service it. That's the number one risk is, can I service this debt? The hotter I run the debt, the smaller my margins get, and the less safety I have in being able to pay that leverage off when anomalies in the market happen.
Well, sure.
So with that in mind, what's your thoughts on a ratio of debt to equity? Is there a number? Is it a feel? How do I know if I'm not using leverage, I'm not shorting the dollar, which I have to do because it's going to go down. It's the only call I can make. So if I don't use any debt, I'm not shorting the dollar. But if I use too much debt, one little anomaly can put me underwater, and that's when things just implode, as they did in the 2008.
Well, yeah, sure, debt's a two-edged sword. I mean, we've seen that back in the 2009, 2008, 2010 period, everybody thought real estate was going to the moon. And so you had a lot of people buying houses with small down payments or 10 or 15%. And so while this sort of downturn in housing may only happen once every 15 years, their equity was wiped out. So that's really tough if you got a house and your equity is totally wiped out because you put too much leverage on it. And real estate's one of the most conservative. It has steady rental income, particularly in the individual home area, with say, commercial properties that are now emptied out because of COVID, no one going to work anymore. Everybody thought for decades that commercial real estate was basically untouchable by recessions or inflation and things like that. Now a lot of these big cities, you've got office towers trading at 30 or 40 cents on the dollar. So there is no real harbor from the negative effects of debt. So, you've got to think about, as you said, what's the margin of safety when I'm borrowing? And for real estate, you may be a reasonable approach for people that are watching this show might be 50%. If it's, say, a rental property, they're buying 50 or 60% tops, because you want to survive if there's a downturn. For your home ownership, 70%, 75% is probably a reasonable number. For stocks, if I was buying stocks on margin, I probably wouldn't go above 30. So I just think stocks are too volatile.
Well,
Real
interest
estate
rates.
is much less so. And
Yeah,
when you look at numbers and statistics, I mean, most big lenders will look at a leveraged buyout, which is a stock essentially, and they will say, I want to see total debt service, which would be interest plus whatever principal, covered by cash flow, which you like to talk about a lot, by at least 1.5 times, which is pretty narrow, and preferably higher, preferably twice, 2 times. So let's say if the free cash flow of the building or the company was $200 million last year, the lender wouldn't want to have more than $100 million in debt service. It's covered 2 to 1. So as you said, if there's a recession or a bump or anomaly in the road, the company can survive. In real estate, the ratio is usually a little smaller because it's more consistent cash flow generator. So, it might be 1.6 times. If you translate all the numbers, what's that mean for an individual? It means if you're buying a house, they usually want to see your rental, insurance, or principal payments, real estate taxes covered, say 3 to 1, so that they know that you have enough money left over to eat and drive your car and things like that. So these are some kind of basic ratios that the audience, got to keep in mind.
Let's talk a little bit about, and I'm biased here, so we have to keep me under control. My biases come out. I'm an educator. I'm an education advocate for financial education. There's a couple of reasons I'm passionate about this. Collectively, it's important because I believe our electorate is profusely uneducated. I mean, tragically uneducated. To go into a voting booth and not understand monetary policy, fiscal policy, whether you are right or left, to go in ignorance is you have a duty as a citizen who votes to be an informed person when you do that. And I just think there's a complete, there's entrepreneur classes at the high school or budgeting classes at high school. These are it's almost as if they're non-existent. So collectively it's important. Individually, it's even more important because the only financial statement that really matters isn't the federal government, who's now got a true $1 trillion deficit. It's your financial statement. It's the listener. It's the person listening here. The quality of your life, a lot of it's about your own financial health, and it's terrible. So a couple of things here on I don't like to throw curveballs, so if I put you in a rough situation, say I decline to answer. As an educator, if you fund real estate, like let's say we outlawed the mortgage industry, well, prices would just disintegrate. I mean, debt is an enabler. We have to expand credit to keep the growth. If we don't expand credit, we can't grow the GDP. So debt enables purchasing. So if I decide I'm going to get a student loan, and I say we got to make student loans easy to get, that's going to raise tuitions because more people can go. I think a student loan's the worst loan ever. There's no collateral, there's no cash flow, there's no job, there's no guarantee they'll even finish school. What's your opinion on the state of borrowing money to get educated in our country today? How do you feel about that? Is that a great ROI? That, hey, yeah, but once I get this education, I'm going to have this brain that can go to work and it's worth it, or no? Because it's expensive.
I think I support the student loan program, but you make a good point. I mean, there has to be a limit to what students borrow if they're not going into one of these fields where there's pretty much a certainty of getting a good job. Like, let's say you're an accountant or you're a chemistry major, or let's say you're going to a top law school, or you're going to a medical school where you pretty much guarantee you have a guaranteed income. The problems that I read about with student loans, a lot of these people borrowing loans, and they are going into some field like sociology or helping nonprofits where the salaries are kind of low. And, only a government would make this kind of loan on the basis that it promotes social good. And, the student loans that you see that are backed by private companies usually want the parents to guarantee the loan. And so that would be I guess, the collateral for them. But, education in general is a social good. It's kind of expensive these days compared to when I was in college. And I took out student loans. But, I had a pretty good income when I left, so I could pay them back. And most of these people, Americans in general don't look that far ahead. And you don't have to just pick on the average citizen for not having a financial education. I mean, you just mentioned the $2 trillion deficit and the $35 trillion in debt. And these are all legislators most of them are highly educated with graduate degrees, and they have a whole staff, and they just keep rubber stamping all these budgets. So why do we got to pick on the average guy in the street? There's plenty of people in Washington we can direct that anger to.
You look at that debt of 30 plus trillion, and that's money that's been borrowed and funded. But if we look at the unfunded that's been promised, we got to pay everyone's Medicare. We got to pay all the income stability. We got to pay all this. That's north of 200 trillion now.
Yeah, but you got a lot of income coming in the government from your ongoing taxes. So yeah, it's something that's got to be dealt with. But they're just kicking the can down the road as they have been for the last 25 years. When Clinton left office, we had a glide path toward a balanced budget. I don't know if anybody besides you and me remember that.
I understand the kicking the can down the road. I feel like we're rolling a snowball up a hill.
Pushing a big rock uphill, huh? One thing I think
it gets bigger. It gets bigger as you go up, and the potential energy gets bigger.
One thing we got to touch on, Andy, which we haven't really, is why do we talk about private equity on a show like this? Because historically, all the private equity funding has been done by these huge institutional investors that control billions of dollars. But what's important for your listeners to know is that in the last 2 years, the federal government has thrown off the restrictions. Before 2 years ago, the average person making $100,000 with a few $100,000 in their 401k, which still is only the top 40% of the population has that kind of net worth. Those people could not buy into private equity funds because the government took a paternalistic attitude. They said, well, these people are unsophisticated. They're going to get ripped off with the fees. They don't know what they're buying. They're not going to go through a 90-page document like Harvard's management office is going to do. And therefore, we got to protect them, and we're not going to let them invest in these funds. That's all changed. So the big trend in the private equity industry is that these private equity funds are hooking up with the money managers that you're quite familiar with, such as Capital Group or T. Rowe Price, and they're going to Vanguard. They're going to hook up with these name retail investment-oriented managers and start selling private equity through these distribution systems. And that's why your viewers are going to see this topic a lot more. It's going to be all coded in legalistic language, and it won't be as straightforward as I think you would prefer for your listeners. But they're going to attack the 401k market because the institutional market's been tapped out. So to grow, they got to go after mom and pop, Joe Sixpack, and that's their next objective. And so they're just starting that, and the lines of attack are being made clear. And this is something that, maybe your listeners might want to look at it in more detail at some future date, is how do I kind of duck and weave and pick maybe one or two funds as opposed to getting, kind of snowballed into buying deals that aren't very good.
You make a great point. As private equity grows as a larger portion of the system, in other words, this amount of debt can contribute to systemic risk. I think if we have lots and lots of debt, the more debt you have, the more potential you have for a systemic problem if the system becomes dependent on that. And you make a great point about the most important phrase on Wall Street, I think, is assets under management. That is their deal. So, when the 401k emerged, they were like, my gosh, here we go. Let's pounce. Let's get as much. You look at Kentucky and the teachers in Kentucky with their pension, they put their money in this stuff. These guys on Wall Street are looking for different places to where they get more AUM, and as you mentioned, they're going to be looking at a lot of different places and going after mom and pop's cash.
A 401k might only have 100 or 200,000, and you say, well, what's the big deal? If they charge me 1 or 2% a year, that's only 3,000-4,000. But you're the one that pointed out earlier in the show that 2,000 or 3,000 that's being deleted from your money every year. If that had been allowed to compound, you're adding 3 or 4% every year to your retirement fund as time goes on. But the interesting thing I've looked at or examined, maybe you've done the same with working with these older people that have asked me for some advice, free advice really, is the fees. If you get a quarterly or monthly statement from these big money managers, the statement's like 17 pages long.
Yeah, they don't see those.
They're going in and outside of these funds every week under the mantle saying we're managing something, but they're basically buying index funds and going in and out of them. And the fees are like in small print on page 16. I think it's highly misleading, and they're allowed to get away with it. The government's very passive with respect to Wall Street, in my opinion. And then, that money, a few thousand a year, is getting, cut out of your retirement income.
To your point, and we talked about this earlier, but I think it bears revisiting. The fees are one thing, but the headwind on compounding is really the bigger issue. And John Bogle, the late John Bogle, founder of Vanguard, he wrote a fantastic book called the Battle for the Soul of Capitalism. Now, this was written, 2005-ish, so it's about 20 years old. Back in those days, it wasn't 1%; it was like 2.5%.
Really?
Yeah, and he has an example in this book that's astounding. He says you take a person who takes $1,000 at age 20, and he puts it in the market, goes to 65, another 20 years before he dies. So the way Wall Street looks at this is they say, what is the earning potential of $1,000 over a person's life? That's the way they look at it. With no education, just throw it in the S&P at 8%, what's that going to be? Well, it works out to $148,000. That's the earning potential of $1,000 over a human being's life from 20 to 65. Now, he says at 2.5%, if they pull that out, that actually reduces the compounding power from 8% in the market to 5.5, which means that their statement minus fees, they'll get $32,000 of that $148,000.
That's an incredible number.
$110,000 goes to the financial system because those fees are compounded in the market without the headwind once they obtain them. And I went through and I said, I'm going to do this math at 2.5, 2, 1.51, and 0.5. Even at 0.5, at 2.5, Wall Street takes 80% of the money. 80% to mimic to mimic the market to get what you're going to get anyway.
Just think of 2.5% out of 8%. That's almost a third every year of what you're making.
It's incredible. And then at 0.5% over their lifetime, you're still giving a third of the money to Wall Street to do what it would have done anyway.
Getting back to the private equity for a second. So you're talking about these big 401k plans that are basically maybe back then the fees were quite high. Still at 1%, it's a big number as you put out as well. For the PE funds with the fees of 2 or 3%, like you said, just over a 10-year period, they're taking 15%. So if you put in $100, you're only putting $85 to work. And so you're already, it's like starting on the 10-yard line instead of the 30. So you've got a lot to make up by much higher returns, which they don't achieve. And these are big institutions doing it. These are big institutions stepping in there and cutting off 15% of their money from day one. I get asked by a lot of people, why do they do it? Why would they do that?
because people will pay. Maybe we need to back up, and when we say, "Hey, these guys aren't geniuses," maybe we say, "Well, actually, they're in a position of, well, if people don't believe in my concept of infinite return with no risk, well, just look at the 401k program. They don't put any of the money, and they don't take any of the risk. Their ROI by percentage terms is infinite, and their risk is zero. That's genius." So
if you look at the money managers, it's one of the most profitable businesses in the United States. Like a typical public money manager, like these big firms we talked about, their profit margins might be 20 or 30%. If you look at the private equity funds, if you look at their profit margins, they're around 40 or 50%. So the revenue coming in, the clear profit is 40, 50%, which, it's the profit margin you don't find much outside organized crime. It's unbelievable what profit margins are like in this line of work.
In fact, you talk about organized.
As I said, your viewers might be saying, well, then if the fees are so high, why do Harvard and California Pension Plan,
CalPERS,
Ford Foundation, why do they all buy it? Well, it's all because the investment staff that works there at CalPERS and these other places have designed a program for their trustees that makes everything very complicated and sophisticated and secret-like, so that the trustees, most of them political appointees who, may be lawyers or ex-cops or whatever from the unions, they don't really get it. And so by making everything sound so complicated that the average person can't understand it, they're able to justify their jobs for very high salaries. So you might look at a investment manager of a university pension plan, which is not going to beat an index fund, and most of them don't, and they're getting paid $3 million a year. They might be getting paid more than the president of the university, and yet they can't beat a simple Vanguard index fund. So they're making things complicated to kind of protect their jobs, and that's not right. It's simply not right.
And thus it is incumbent, or maybe not incumbent, but our opportunity to learn and educate ourselves by going to Amazon.com and purchasing your copy.
You're right.
Purchasing your copy of The Myth of Private Equity, an inside look at Wall Street's transformative investments, and I might also add securities analysis on Wall Street, a comprehensive guide to today's valuation methods. Jeff Hooke, just an incredible conversation. I'm lucky to do a podcast because, as you mentioned, at Thanksgiving dinner, we don't get to talk about this stuff most often with our family. So to have the chance to chew the fat a little bit about these issues is just a treat for me.
Something, Andy, I just think a podcast like yours and, some of the classes you run, I just think it's very valuable for the average person. It might even be valuable for people that are a little up or high, maybe higher on the net worth scale than the average person. Because the average person, unlike, what people don't realize, maybe, as I should say it differently, what people don't realize in this country is that 60% of the population has virtually no savings. They don't have a 401k. They don't really have much equity in their house. They're renting. And so when they retire, they're basically highly dependent on Social Security. And so what we're talking about is really the 40% that do have savings, of which, the very vast bulk of the savings is in the top maybe 5%. I think the top 1% might own 60% of all the stocks and real estate in the country, and then you get top 5 probably at 80%, and then you got 20% might own 20%, and 60% have almost nothing. So these facts, people bring them up in the newspapers and media from time to time, but people don't want to hear it. They think the American dream is alive and well, and I think, maybe the last election proved it isn't, that people are still kind of frustrated. Just on a side note, last night I went to the book signing or a book presentation by a guy named Bill Gates. You may have heard of him. He's got a new book out.
I have heard of him.
So he was there on the stage with Savannah Guthrie of NBC, and he was taking questions about his book, which is basically the first 25 years of his life. He's going to do a couple more books, he said. But she also asked him a lot of questions about stuff that you and I are kind of covering right now, and in a way. And then she asked him a lot of questions about politics because she was in Washington. And, he had some interesting things to say. It wasn't a totally softball interview, but I thought it was somewhat, gutsy of him to get up there and take questions from her that, were not totally designed to make him look good. He had told us, the people in the audience, there's like 1,000 people, that, he'd been to the White House earlier in the day to talk to Trump for a few minutes and the chief of staff about some of the things in which he's interested. And anybody on the telecast or people you can contact, would like to hear what he's sort of got to say about various political issues and social issues and artificial intelligence and all that. I thought it was kind of an interesting talk. And, one that was saying to my wife when I got back, I said, this would be a perfect YouTube podcast of him just taking questions like Savannah Guthrie did. And maybe someone recorded it on their cell phone, who knows?
This is a great point to wrap up on when you said, a lot of this wealth is really concentrated in the hands of few. And I might be too much of a simpleton. If you look at Warren Buffett, I think Berkshire now is probably equivalent to maybe 5% of the S&P, which is just phenomenal. I mean, it's just really remarkable that a guy could pull that off. And and he's kind of an individual. Berkshire he cares about his investors truly. The institutions, BlackRock, Vanguard, the ones we talked about. Vanguard comes out every year with a report on, it's called How America Saves. Every year I download it. It's a great report. $11 trillion in the U.S. in 401ks. Vanguard's probably got $2 trillion of that. That's pretty good sampling.
Is that right?
And pretty good sampling. The one I always look at is the demographics. Get this stat, and this is this year. Vanguard says that the median balance of a 401k at Vanguard, defined contribution. I'll be clear. Defined contribution from age 55 to 64 is $89,000.
Gee, I tell you, Andy, I thought it would have been higher than that.
The average is 6 figures, but the median is 89. Now think about this. If you pull a 4% withdrawal rate on that, that's $298 a month.
Yeah. I mean, we're not equipped for retiring, I guess. People, how do you live off that plus social security?
Yeah, you're not. So here's what's interesting. Why such a disparity? Well, you made the comment that if they have these fees and they use what Bogle, you said it was mafia. Bogle called it criminal and financial tyranny. He said that because these fees begin to pull the money over in the name of giving financial advice, it concentrates that wealth with these compounding figures we've talked about. My advocate for education is as soon as you can possibly start your kids in owning part of America. The way I look at real estate is there's not a lot out there. So if I get a piece of land, I'm not selling it. I'm not going to flip it. I'm going to trade it. I'm going to keep it. And if I can get a piece of the GDP or the S&P and a share of that, I'm not giving it up. People don't, they're not taught it. They're taught in school to earn the money and give it to Wall Street rather than earn the money and buy a true asset that they control, assets under their management rather than the others. So these conversations, you can tell I get pretty fired up, passionate about this.
Andy, look, it takes a lot of discipline to put part of your paycheck away every week if you're 25 or 30 years old. If you've got children, you know that. And I had this kind of conversation with one of the Hopkins economic professors, and he said, well, Jeff, you got the wrong idea. These people in their own mind are rational because they want to spend the money now and they'll worry about the future in 30 years. If they don't know if they're going to be broke or not in 30 years. They don't care, but they want to spend it now, and the hell with the future. They'll worry about that later. So it may be a rational economic decision, at least in the view of this professor, to just spend the money now and worry.
Well, it has value.
I mean, you and I might sleep better at night because we got a nice 401k and other savings, but not everybody thinks rationally in that respect. At least I don't think they do. And I guess you don't either.
No, I think that it's certainly a new age and a new culture, and I guess I start sounding like I'm an old man now. The way I
maybe. But here's what there could be some encouragement in some states. I'm in Maryland. Maryland was trying to get this law passed where every employer had to offer their employees a 3% deduction from the paycheck to go into some 401k run by the state, and then the state would run, a index, kind of a blended index fund, I guess, like you see at Vanguard. And it was hard to get these things off the ground, but that way the 401k could be transferred among you if you ever change jobs. And once you take 3% out, the employee's going to forget about it, right? They're just going to keep paying it. They're not going to acknowledge that it's growing until maybe it's gotten big enough where they think they can withdraw some of it. So, but these people.
I look at the confidence I have in Wall Street to manage money, and it's pretty low. And when I think about having the government involved in it, my confidence, when I look at how they run things, I'm not sure that I would be thrilled to say, well, let's see if the government usually equals more complicated and more expensive.
Yeah, I mean, I guess they could hijack it and put it back in the same high fee programs that their state pension plans are. But your viewers, I mean, what kind of questions do they ask someone like you? Do you have a call-in times and stuff like that from time to time?
I've never done a call-in, but I will tell you, my philosophy is pretty simple. And this is why I always have guys like you come on the podcast, because I believe reading books like yours is a habit that is so critical for people. Because here's the thing, it's like Warren Buffett said. He said this, I'll probably butcher this quote. He said, the ultimate irony of the financial industry is that an obstetrician will deliver babies better than a husband or wife. And if you take dentists as a whole, they'll fill teeth or they'll remove teeth better than if the patients try to do it themselves. But in the investment world, somebody who believes in American business and will be consistent in that business will outperform the Wall Street guys. It's the only industry where they subtract value. So I say, look, is this skill of investing a skill for hire in your life or a life skill? Make that decision. If you decide that it is not a life skill, you will have to give your money to governments, give your money to Wall Street, give your money to others who will not have your best interest at heart. There's an inherent conflict of interest there. So I say, is this learnable? Can a person pick up, your book, Practical Guide to Doing the Deal, The Myth of Private Equity, Securities Analysis? Is there information that the average person can gain from that where they say, I'd like to make this a life skill. I'd like to be like Andy's kids who say, I will never pay fees. I will learn how to buy solid companies that give a good cash flow, learn how to augment that, the best I can conservatively, and things like Roths. I'm going to do this myself because it is a learnable skill. That's and I might be wrong. I've been doing this for I've been doing it 30 years, and I just know that I was a basketball player. So that tells you right there. The closest I'll ever get to Johns Hopkins is my son's a pretty good student. And he's got a letter from their coaches a couple of times his senior year saying, hey, why don't you come be a doctor at Johns Hopkins? We know you play basketball, but you look like you get pretty good grades. That's as close as this interview got me one step closer to Johns Hopkins than I'll ever be.
I'm a big fan, so we're going to the Wizards San Antonio game on Monday.
Nice. Go watch Wemby.
We traded Kyle Kuzma. We got rid of Valanciunas. And so San Antonio's got, the big star.
Wemby's something.
I just hope he doesn't blow us out. But I used to play a lot of pickup basketball when I was younger. I loved the sport. I just think it's a great exercise.
Such a great game. Well, this has been a fantastic conversation. Hold on just a bit after I close the show so I can properly thank you. My guest has been Jeffrey C. Hooke. He is the author of The Myth of Private Equity, Insider's Look at Wall Street's Transformative Investments. Check out this book and others on Amazon. Get yourself educated and get your piece of the pie. Know how to value things, know how to acquire things, be smart with how you lever, and grow your wealth, and most importantly, grow your cash flow. We'll see you next time.